Hello everyone, and welcome back to our derivatives course. Today, we'll look at a strategy designed for moderately bearish investors, the bear spread using call options. By the end of this lecture, you'll understand how this strategy works, how it is constructed, and when to use it effectively. A bear spread using call options is a strategy that profits from a moderate decline or stability in the price of the underlying asset. It's created by selling a call option with a lower strike price and buying another call option with a higher strike price. Both options have the same expiration date and the same underlying asset. Bear spread using call options produces a net credit because the lower strike call, the one you sell, is more expensive than the higher strike call you buy. This is a limited risk, limited reward strategy that allows traders to earn income from premiums while controlling downside exposure. Let's go step by step through the construction of the bear call spread. Step 1. Sell one call option with a lower strike price. This generates income upfront. Step 2. Buy one call option with a higher strike price. This limits the potential loss if the underlying asset rises sharply. Both options share the same expiration date. The result is a strategy that starts with a net credit, meaning you collect money when you open the position. You want the stock to remain below the lower strike so both options expire worthless, allowing you to keep the full premium as profit. The profit and loss depend on where the stock ends up at expiration. If the stock stays below the lower strike, both calls expire worthless, and you keep the entire premium. That's your maximum profit. If the stock rises above the lower strike but remains below the higher strike, you begin to lose part of your profit. If the stock rises above the higher strike, both calls are in the money and your loss is capped. Here's a summary of the payoff structure. Maximum profit equals the net premium received. Maximum loss equals the difference between the strike prices minus the premium. Break-even point equals the lower strike plus the premium received. Let's work through an example. Suppose the underlying stock is trading at $50. You sell a call option with a strike price of $50 for a premium of $5. You then buy a call option with a strike price of $60 for a premium of $2. Your net premium received is $3. If the stock stays below $50, both calls expire worthless, and you keep the $3 premium. That's your maximum profit. If the stock rises to $53, your short call loses $3, which offsets your premium. That's your break-even point. If the stock rises to $60 or above, both options are in the money, and your maximum loss is $7. The $10 difference between strikes minus the $3 premium you received. This structure gives you a clear view of your profit and loss boundaries, limited upside and limited downside. Notice the flat line at your maximum profit when the stock price is below $50. Then the line slopes downward between $50 and $60 as your profit erodes. Above $60, the line flattens again, marking your maximum loss. This visual shape clearly illustrates how the bear call spread benefits from stable or slightly falling markets. So when should you use a bear call spread? It's ideal when you expect the market to remain flat or decline slightly. It generates income up front, and because you own the higher strike call, your loss is capped. This strategy also benefits from time decay, meaning as time passes and the stock price stays low, you keep more of the premium. Volatility is another factor. Since the position has negative Vega, it benefits when volatility falls. From a Greek's perspective, delta is negative, bearish bias. Theta is positive, benefits from time decay. And Vega is negative, benefits from lower volatility. In summary, the bear spread using call options is a conservative bearish strategy that generates income while keeping risk limited. It allows investors to profit in neutral or slightly bearish markets with a clear understanding of both maximum gain and loss. This concludes our discussion about bear spread using call options. See you at the next lecture.